Hello everyone, and a very warm welcome to this ICAS webinar, which is of course the second of our two-part series in our spring tax updates. For those that don't know me, my name is David Mingus. I'm Director of Practice here at ICAS, and it's my great pleasure to be the host of your webinar today. So in this series, we're providing an essential roundup of the most recent tax developments. And while there hasn't been any formal fiscal events, as the government refers to it, that hasn't stopped a raft of announcements being made alongside the spring statement delivered by the Chancellor at the end of March, and of course more recently the tax administration date. So in the first of our Spring Tax Update series 2 weeks ago, which is available for you to view on demand if you missed it, we looked at developments in relation to the main general taxes. But in today's webinar, we're going to be concentrating on recent developments across employment and employer-managed business taxes. And to help explain us and understand those issues, I'm delighted to be joined by my colleagues, Chris Campbell and Justin Ricomini. So Chris is Head of Tax here at ICAS for tax practice and OMB taxes. He's a chartered accountant and chartered tax advisor and joined ICAS after a career in practice working with owner-managed businesses. He supports members with technical queries and represents ICAS on various HMRC stakeholder groups. Justine is Head of Devolved and Employment Taxes here at ICAS and represents ICAS at several HMRC and industry forums in relation to employment and their related tax positions. Justine's a recognised expert in the field, known for bridging both practical experience and bringing together her deep technical knowledge. But before we begin, just a few housekeeping reminders to remind you of. You can, of course, submit questions at any time through the Q&A facility, which is accessed at the top of your screen. Questions can be submitted anonymously if you want, and we will be saving all questions until the end of the webinar, where we have a live Q&A section. You can also join in the conversation through the chat box, which is also accessible at the top of your screen. And this allows you to comment or discuss with your fellow attendees on matters covered by the webinars. So while both the Q&A and the chat facility should be available for virtually everyone on the webinar, occasionally I would just highlight that due to your own organisation policies or the browser you're joining from, it's possible that one or both of those may not be available to you. We are, of course, recording this webinar and we'll make it available for on-demand viewing afterwards in case you want to refer back to it or share it with others. And the slides will be available after the webinar and can be obtained on request using the link which will be in the post-event webinar email, or you can email separately our events team at events@icas.com to request a copy of the slides. So as I say, we look forward to receiving your questions throughout the course of the webinar, and we'll of course try and get to as many of those as we can in the time that allows. But I do know that both Chris and Justine have a huge amount to get to, so without further ado, I'll hand straight across to Justine to get into the detail of today's webinar. Justine, over to you.
Thank you very much, David. I'll take myself off mute. That's always a good start, isn't it? Hello, folks. It's good to be here again, just delivering this update for you this morning. So I am just going to move the slides along a little bit to the employment taxes section. So I've got a few bits and bobs to run through with you today. A lot of these are more updates from what I spoke about last time we all were together. And there are a couple of new bits in there which I've added in to bring it all up to date. So I'll start with national insurance contributions. I'm showing this slide again as a reminder because this is what was announced in the last autumn budget, but it all kicked in on the 6th of April 2025. So obviously on this slide, we know that for employers, the rates have risen from 13.8% secondary national insurance to 15%, and that applies to classes 1, 1A and 1B national insurance. So effectively, we're talking about extra national insurance for employers on benefits, expenses, termination payments, sporting testimonials, and pay-as-you-earn settlement agreements. And the sting in the tail with the national insurance is that the rates for employer hasn't just gone up, but the thresholds have actually been lowered as well, at which point that rate will apply. So it's been reduced from £9,100 to £5,000 a year. So obviously a greater portion of wages and salaries, etc., will be subject to that 15% rate. Obviously, national insurance is a reserved matter, not devolved, and therefore it's got nothing to do with the Scottish Government or anything like that. They can't influence it in any way whatsoever. So just a couple of little changes that have come in as well as a result of the spring statement. So national insurance small employer compensation rate. There's an increase in the small employer compensation rate. This is to compensate small employers for the additional costs of paying national insurance for employees who take statutory parental leave. So due to an increase in employer national insurance contributions, the rate corresponding to this will rise from 3% to 8.5%. So a very small amount of additional relief there, and that's effective from the 6th of April 2025. And employer-related securities, the employer's national insurance elections process has been revised from the 1st of May 2025. The process to make a joint election is being simplified because you don't need to submit the election form to HMRC to obtain pre-approval now. If you're using the new election form template from gov.uk, that pre-approved template from the 1st of May 2025 just means that everybody who applies will be doing it in a consistent manner. So hopefully that will simplify things for anybody who's involved in share schemes. So I'll move on to the employment allowance. In the autumn 2024 budget, some changes were made to the employment allowance, and at that time we didn't know whether employment allowance still counted towards state aid and subsidy control rules. I do now know that it doesn't any longer, which is actually really great news because it was quite complicated if you were dealing with a business that was involved in the state aid regime and involved in subsidy control regime, because the employment allowance counted as state aid. So you had to work it out in euros, bizarrely, and then work out the limits and to make sure that you weren't exceeding those limits. So also, just a quick note again about the lowering of the secondary national insurance threshold from £5,000 to £5,000 from £9,100. So really, this is just to point out that the additional national insurance which employers will have to pay in 2025-6 will far outweigh the new employment allowance levels. So the Chancellor did say at the time that she brought it in the autumn statement that the additional employment allowance was being put in at 10,500 to fund additional jobs, but it's actually likely to be swallowed up by the additional national insurance that employers have to pay, really. There's an obvious risk associated with the rise in employment allowance for the accountants among you to be aware of, and that's the increased incentive for the formation of so-called mini umbrella companies, which have presented HMRC with a a real genuine headache actually in terms of fraudulent claims of employment allowance as well as flat rate scheme VAT. Just a quick note about employment allowance. Public bodies or businesses who carry out over half their trade with public sector bodies, such as local authorities, NHS services, can't claim employment allowance unless they are a registered charity. And neither can companies with just one director, where the director is the only employee liable for secondary Class 1 national insurance. Certain employees can't be included in an employment allowance claim, such as someone whose earnings are within the off-payroll working rules, and also someone that you might employ for personal, household or domestic work, such as a nanny or a gardener, unless they're a care and support worker for that individual. So let's move on to national minimum wage. We spoke about this last time, but I wanted to include it again because obviously we're looking from the 1st of April 2025 at some increased figures there. And really, what's happening here is that there is actually a considerable increase. The government want to support low-paid workers against rising living costs and bring the national living wage closer to 2/3 of median earnings, which meets government targets. So the Low Pay Commission, who design the national minimum wage figures, were specifically tasked last year with considering the cost of living and future inflation trends in its recommendations, which has never happened before. So these new statistics, which have been brought in, are from the Office for National Statistics, and those insights have been included in the Low Pay Commission proposals and were subsequently accepted. So just a quick note on living accommodation offset, because it does confuse quite a lot of people. It's been increased by 6.7% to £10.66. And this is an amount which is deemed to be included in an employee's pay if their wages are below national minimum wage, but they live in rent-free accommodation. So £10.66 is part of their pay. And the value counts towards the national living or minimum wage. And just a quick note where we've been discussing about sort of the employment allowance funding additional jobs, but actually a full-time equivalent role of 35 hours a week will now cost an employer around about £427 a week, or £22,222 a year, plus pension if they're auto-enrolled, and a 15% secondary national insurance liability on earnings over 5,000, which comes to about £2,500. So you're looking at about, to employ somebody on national minimum wage now, you're looking at a liability for the employer of about £25,000 a year. So the employer needs to be earning at least that amount of money just to break even and pay someone. So I'll just have a quick chat about vans and cars, because there's a new approach from the 6th of April 2025. And the HMRC are no longer going to align car and van definitions for benefit in kind purposes with the VAT definitions, which is a bit of an annoying complication in the rules, actually, because it was always good that you could use the same figures for both things, but that's not going to happen anymore. One of the main things about the announcements from the spring statement were that the contrived car ownerships will receive additional scrutiny from HMRC going forward. The government are going to introduce legislation in a future finance bill to close loopholes in employee car ownership schemes to prevent them from being used to circumvent the company car tax benefit in kind charge. And those changes are going to take effect from the 6th of April next year, 2026. So just moving on to the company cars regime, I put this slide back in the pack because as far as I'm concerned, we just need to bear in mind that these are the benefit in kind charges for 2028, 29 and 2029-30 that were announced in the autumn statement. And, you know, obviously for people to budget for these kind of things, or if you're considering renewing your fleet, etc., then it's always a good idea to bear in mind what's coming further down the line. So I think we will continue to remind you of those figures going forward. In terms of payrolling of benefits in kind, this was supposed to be coming in a mandatory fashion from next April 2026, but it's actually been put back. The Exchequer Secretary to the Treasury made a decision a couple of weeks ago about delaying the mandation of payroll of benefits in kind for a further year to the 6th of April 2027. The idea is to give everyone, including HMRC, more time to prepare for this mandatory reporting of the income tax and Class 1 Class 1A NICs for most benefits in kind and for taxable expenses. So that's going to come in from the 6th of April 2027. And you'll see if you look at the ICAS website, I wrote an article about it, and I've also written to the Exchequer Secretary to thank him for making the sensible decision to delay it, because actually if nobody's ready to do it, including HMRC, then it may well have just fallen over, which is no good to anybody. Just a quick note about umbrella company pay-as-you-earn transfers from April 2026. Again, we're looking at the future, but we need to keep a weather eye on it. The legislation coming in will shift pay-as-you-earn responsibility from the umbrella company to the recruitment agencies in the labour supply chain. And that is obviously a measure being brought in to counter avoidance by umbrella companies. So hopefully there will be a little bit more regulation coming in as well of umbrella companies and that sector generally, because at the moment it's very sparse. And I'm just going to quickly talk about ITPA 2003 Section 690A requests, which are for internationally mobile employees, if any of you have clients who deal in global mobility. They have been simplified, which is actually really good. There has been a bit of a sting in the tail from it, because the understanding was that when you were putting in a 690A request, you wouldn't need a 64.8 anymore. However, that's not the case. Since the new rules came in, there's been a few reports of confusion arising, where HMRC have rejected the new globally mobile employee pay-as-you-earn notifications process from employers because there was no 64.8 authorization for agents in place. So in fact, the guidance was a bit confusing. It was saying that the GME pay-as-you-earn notification was supposed to be enough on its own. Anyway, we asked HMRC to clarify the point, and actually it was yesterday that they came back to us, which is fortunate for this webinar. In fact, we now know that both a 64.8 and a letter of authority are now deemed to be acceptable evidence of the employer giving the agent authority to act in relation to the pay-as-you-earn notification forms. So that was the case under the old process. So in fact, it's just been carried forward and it still applies under the new process. So before I disappear, I'll just mention the Check Employment Status for Tax CEST tool. There have been some updates to the digital tool, which are quite welcome, but HMRC have made some more changes on it in an effort to make it easier for customers to use. The tool's questions are more accessible than they were before, and they cover a few different areas that looked as if they were sort of not really getting the answers that were needed for the tool to be able to assess status. So there was a lot of kind of, it wasn't a yes or no answer, it was a sort of a maybe answer, which is no good to anybody if you're trying to decide whether somebody's employed or self-employed. So the changes don't affect how the CEST tool actually determines if a worker is employed or self-employed. The legislation and guidance that sits behind it is effectively the same. So the point of view of HMRC in any of this has not changed. So I just wanted to sort of emphasise that a contract under the CEST tool points towards employment for tax purposes. If you have an obligation to accept all the work, that you have no genuine right of substitution, the client has detailed control over how, when and where you work, to integrate into the company's structure and behave as an employee, that you are subject to a detailed disciplinary process, and you must use the client's equipment and resources, and you receive regular and fixed payments which are not tied to specific deliverables, and that you also may receive benefits that are in keeping with those of an employee. So I think that might be me for now. I'll pass you over to Chris. Thanks, Chris.
Thanks very much, Justine. Good morning, everyone. I hope the sun is shining wherever you are this morning. I'm just going to cover, there's not a huge amount on the owner managed business taxes front since the last update. So I'm going to start with a little bit of a summary of the spring statement, but there's not a huge amount to say. I know my colleague Susan, who presented in the first spring tax update webinar a couple of weeks ago, she spoke about the tax consultation, so I'm not going to talk too much about that. There were some changes about making tax digital for income tax, which are in addition to those points that we covered with the webinar with Craig Ogilvie. I think it was the day before the spring statement the webinar was. We also have a webinar for making tax digital in the construction industry scheme that Justine's going to be presenting in June, where Rebecca Stewart is going to be covering some specific aspects on the construction industry for those businesses which work in the construction sector. So if you're interested in that, please do sign up for that webinar on the website. Where we did have some more announcements was in this new word. HMRC likes acronyms. So this new word is TUSAR. Now, when I heard that, I thought it was some breed of cat food or something like that. It sounded like something along that line. So TUSAR is the new Tax Administration Day, which we used to have TAM. Now we have TUSAR. So there's some more announcements in there, but the bulk of what's happening in the owner managed business space is pretty much those announcements that were announced previously, such as in the autumn budget, now taking effect. So clients are now starting to come through with accounts or have more queries as these changes are taking effect. But we start first of all with making tax digital. So we've known for quite some time that the 2026 deadline for gross income for sole traders and landlords above 50,000, 2027 for gross income and landlords above 30,000. We knew about the 20,000 threshold, but we only had a commitment that it would be brought in by the end of the Parliament. Now, we now know it's going to be in April 2028. Now, ICAS has been quite vocal that we think that this is perhaps a little bit premature, that HMRC should perhaps have had a little bit of time to see how those businesses which are in the testing phase, how they got on with submitting their quarterly updates, how the first cohort of sole traders and landlords were getting on with the quarterly updates from 2026, but the announcements we made, decisions we made, 2028 is when it's going to come in. So now, although we think it was a little bit premature, it does set the scene. So we're really, really clear there have been delays in the past, and that has resulted in a lot of businesses, a lot of tax agents and accountants decided, actually, we'll just wait. We don't think this is going to happen. It's probably going to get the kick down the line a little bit. Whereas I think this is as clear as we can be that April 2026 is definitely happening. And we're seeing that now in all the announcements that's happened. There's been a commitment from the government and the Exchequer Secretary to the Treasury is really, really clear. So April 2026 is happening, and we're seeing that in the queries that are coming in from ICAS members. This is probably the biggest area that we're getting queries from members about in recent weeks, and that tends to be along the lines of registering clients for Making Tax Digital. How do you register them? How do you deal with the agent authority for those clients that you've already acted for, and so on. There are no further announcements on Making Tax Digital for partnerships or for companies at this stage. I suspect HMRC will see how Making Tax Digital for income tax goes in the 3 phases that we've got there. But ICAS does certainly recommend that firms think about which clients they could bring into the testing phase. It's a really good opportunity to test your systems, test how it's going to work for your clients, how will it affect things like billing? How will it affect a whole manner of things? But we talked about a lot of these things in more detail in the webinar with Craig back in March. So if you haven't seen that and we want to look at some of those details, it is available for on-demand viewing on our website. What has changed in the spring statement is that the year-end submission must be made by third-party software. Now, there was previously an intention for HMRC to have its own submission service. Now, that's no longer going to be available. Now, the challenge for businesses and agents is to make sure that you get the right software choice. It will vary between business to business as to what the best. Some software packages will be better for particular sectors. And when you have a look at the different options, if you're looking on the HMRC software page, you can see, well, actually, is it going to do the quarterly updates and the year end, or is it just going to do the quarterly updates? Because it may well be that you have to use a different software for the year end if the particular package that you have chosen doesn't do year end software submissions. But I would expect most software providers, if they don't currently do that, will be looking to make sure that as many of their products as possible can offer that year end functionality so that it gets around the problem. It may have an impact on the price, but that's a different issue. What we also saw in the spring statement is an extension of the exemptions for Making Tax Digital for income tax. And ICAS continues to have dialogue with HMRC on exemptions, and particularly factors such as digital exclusion, which will affect a much larger cohort of taxpayers than it will have done for Making Tax Digital for VAT. So we're still having dialogue on that. But in the meantime, the exemptions have been extended for taxpayers with power of attorney, non-UK resident foreign entertainers and sports people who have no other MTD income, where HMRC cannot provide a digital service. And there's a partial exemption, if you like, for a few other categories of taxpayers. So it's just up to the end, this Parliament, Ministers of Religion, members of Lloyd's underwriters, and recipients of married couples allowance and blind persons allowance. A very small range of taxpayers in the grand scheme of things. They will not have to submit quarterly updates for the rest of this Parliament. The process of applying for exemptions more generally is still to be confirmed. I know that pressure has been applied as recently as last week by the professional bodies. I had a few discussions with HMRC and stressed the importance for our members that they're able to apply it in a timely fashion and get a timeliest reply to an exemption application for those clients who are not, we know now, are not going to be within the scope because they should be considered to be exempt, typically, but not necessarily because of the digital exclusion. But that will be the main one. And we think it's important that HMRC sets that process up so that you can apply for your clients and you can get the answer back. So you can then focus your attention on those clients where you are going to have to do the preparation, where you might have to have a little bit of a change in mindset of how they go about preparing for MTD for income tax. HMRC is encouraging agents to sign up 10% of their mandated clients. Now, ICAS is encouraging our members to sign up for testing where possible. I think 10% is perhaps a little bit ambitious, but you can't blame HMRC for trying to be ambitious. It's a massive project. It's probably a 1 in 25 year change in how the tax system operates. And they also, how we're into the new tax year, there is also the opportunity for those taxpayers you're not going to put into the testing phase, but are going to be in the scope of MTD for income tax from April 2026. You can now register them because they don't register automatically. You have to actually go in and do that. Now, it might take 5 minutes per client, but if you've got a large number of your clients that are going to be mandated in the first year from April 2026, the fact that you can start registering them now may well be that if it's a quieter time of year in your practice until tax return season starts to kick off more significantly than run up to SA peak, it might be helpful to get those clients registered now. The other thing that you can do is that you can now set up multiple agent registrations. Now, I've talked about this before in articles on our website and also on the ICAS Making Tax Digital Hub. The idea behind this is if you've got a client where, say, you're doing the year end as the accountant, but the client has a bookkeeper, if they put in a mandate to act for that client, that would then revoke your mandate and cause problems with the year end. So HMRC's recognised that. So they've got the concept of the main agent and the supporting agent. So those multiple agent registrations are now open. So if you're the existing agent on the agent services account, you're the main agent. Whereas if you've got someone else who's dealing with all or a particular source of income for the quarterly updates, they can register now as a supporting agent. The last point in the slide there is a really, really important one, and it's a subject that I have been speaking to a number of members about in recent weeks. And this is all to do with the registering for clients in the agent services account. If you have an existing 64.8 in place for a client, there is no longer the need. It was originally anticipated that you'd have to get clients to reauthorize using a digital handshake. Now, HMRC has confirmed that that's not going to be the case. If you've got an existing client relationship in the legacy HMRC system, you're able to copy across that authority to the agent services account for Making Tax Digital for income tax. And that's a big deal for a number of firms who maybe we have challenges getting a client to reauthorize them. It's really helpful, I think, in terms of both the trial and also registering now for clients ahead of April 2026. So you don't have to copy them across. And when you're registering a client going forward, so you can copy them across, beg your pardon, and that means you don't have to get the digital handshake. Going forward, you will need to use the digital handshake. And when you're registering a client on the agent services account in the future, you can then ask to be either a main agent or a supporting agent for your clients. And as I said earlier on, this would allow different levels of access, typically a bookkeeper, to complete an update. So for the main agents, existing relationships, no further authority. You can copy across that existing agent authority, but going forward, it will be the digital handshake, which is a little bit unavoidable. Other things on making tax digital in the spring statement, we had late payment penalties for VAT and income tax self-assessment from April 2025, 3% of the tax outstanding when the tax is overdue by 15 days, plus 3% when the tax is overdue by 30 days, plus 10% per annum where the tax is overdue by 31 days or more. So moving away from the spring statement for a minute, we had capital gains tax changes back in the autumn budget. Now, some of those took effect straight away. We now have the main rates of 18 and 24%. And from April 2025, so just last month, we have the 14% rate for gains covered by business asset disposal relief. Now, that's going to increase to 18% from April 2026. So that's all, there's nothing necessarily that new. We covered all those in the autumn tax update. But where it might get a little bit tricky is when you're starting to look at those clients where is it in one tax year or another for business asset disposal relief. So the non-BADR gains, they were overnight change on budget day. That all came in, but we had the 5th of April change for up to the 14%, and then next year for the 18% change. So these anti-forestalling rules for unconditional contracts made on or before the 30th of October. Now, you'll have seen articles on our website which talk about the timing of capital gains tax being based on when the contract is unconditionally concluded. That's the normal situation. You don't normally look at the completion date, but under this anti-forestalling rule, there is a particular proviso that the completion date will substitute the normal position in Section 28 of TCGA 1992. Now, genuine commercial transactions are likely to be unaffected by that, but it's certainly worth being aware if you're having a client coming in and they're looking to sell an asset that's qualifying for BADR, just to be sure about what, if you've got a transaction, what tax rate is it going to be at? The other thing, of course, with BADR is that the lifetime limit has not changed, so making sure that you're only claiming BADR on those gains which are within the lifetime limit, which changed a few years, just before COVID, or just before we came out of COVID. Moving on, the cash basis for the self-employed is, again, it's not necessarily a new thing, but I'm just flagging it here because firms are going to be starting to see clients coming through with their first year with the default cash basis, because 24-25 is that first year of the default. So the cash basis, as a reminder, will apply as default for the self-employed, except firms with partners who are not all individuals, LLPs, businesses using HER basis or averaging, so typically farming businesses, and those businesses who claim business premises renovation allowance in the previous 7 years. So where you're in the cash basis, you can claim a deduction for equipment as expense instead of claiming capital allowances. Now, the cash basis looks at the timing of when cash is received and paid. So you don't think about accruals, you don't think about stock and so on. You just look at the timing of when cash is received and paid, but there are some nuances. The first one is that provision that instead of capital allowances, you can claim that as an expense. But for capital items more generally, there are certain things you can't claim at all. So there's no deduction for capital items on the acquisition or disposal of a business or part of a business, on capital items on education or training, assets that are not a depreciating asset, assets that are in continuous use in the trade. Cars are a different one because you can claim capital allowances on cars. So that's the main area where you'll be able to claim capital allowances. Everything else, if you're just looking at small items of equipment that you, in a normal scenario or a previously normal scenario, a traditional accounting scenario, you'd be claiming capital allowances on equipment. You claim that as an expense, but you carry on claiming capital allowances on cars. Now, that's the cash basis is applying by default. We're going to have an article on the cash basis on the ICAS website with some more of the details for you to look at, just in case you want a little bit of a reminder for what it means for your clients. If the cash basis is not the best route for your client, if it's meaning that you're still having to prepare accounts under the accruals basis, say for example for the bank or some other requirement, you can elect to use the accruals basis instead of the cash basis. But you need to be aware that if you're changing basis, that there are special rules, and the article will touch on those special rules in a little bit more detail. Justine mentioned this a little bit from the employment taxes side, but just a reminder about the double cab pickup rules changing for capital allowances as well. So double cabs with a payload of a tonne or more are from the 1st of April for corporation tax or the 6th of April for income tax treated as cars. It's exactly the same issue from a capital allowances side that you're going to find as the benefit in kind. So they're going to be treated as cars. Now, this is a big deal for a lot of clients in particular sectors like agriculture and fishing, but it could well be that there are other instances where your clients might find that they've bought double cabs in the past. They've had the ability to claim capital allowances such as AIA or full expensing as commercial vehicles, and they've been able to have the benefit in kind for employment taxes purposes treated as if it's a van. So we went from this situation of high levels of allowances in the year of purchase, low benefit in kind rules, different benefit in kind rules between cars and vans. So from April, it's all changed. You're no longer able to treat them as they're now treated as cars, beg your pardon, no longer treated as vans or commercial vehicles. So that means no AIA, no full expensing for companies. So what it means is that the business will not be able to claim as much capital allowances in the year of purchase. It'll be dragged out over a much longer period. And cars, the threshold reduced, the CO2 threshold reduced a few years ago. So pretty much you're likely to be looking at 6% writing down allowances, which is a big difference in terms of the capital allowances that can be claimed. Also has an impact on those businesses which lease double cab pickups. There's the restriction there on the because it can be treated as a car going forward. So we spoke about this before. We knew it was happening. There was all that business last year with it was going to be changing, and then it was not changing, and then now it is changing again, and it has changed. So HMRC's updated its guidance on this, and again, this is something that I'm writing an article on, just so that people have the rules up their sleeve, ready for clients. You're going to start to see tax computations coming through with that on it. The other thing that changed in April, which again will start to be affecting clients that are coming through, quite a number of members affected by this large level of member contact in the late summer last year to do with the changes on furnished holiday lettings. So furnished holiday letting has now ceased. So all the tax advantages for properties that qualified as a furnished holiday let in areas such as capital allowances, capital gains tax, the ability to treat furnished holiday letting earnings as earnings for pension purposes, and the exemption for the furnished holiday lettings from the restrictions for individuals with finance costs, where although that rules have that change in the rules is now taking effect. So there's some practical issues where those expenditure, as we said in previous webinars, any expenditure incurred before the rules changed in April, if you were able to claim capital allowances on that expenditure, it goes in the pool and you can carry on claiming. And in future tax years, it's in the pool, it remains in the pool. There's not a clawback because of the cessation of the furnished holiday lettings regime. Where you can sometimes have an issue is, I've spoken to a few members who had clients who were in the process of starting, before all this takes a while to, a lot of these furnished holiday lettings properties might be new build properties. So they've built the property in anticipation of letting it on short-term rentals. And you then find that the tax rules have changed and they're trying to apply for the license to start operating the furnished holiday lettings business, and there's been a delay. Now, I think it will be difficult to argue to HMRC that if the property letting business has started after April 2025, it will be very difficult to argue to HMRC that even though the expenditure was incurred before then, because the normal rules for pre-commencement expenditure as it's treated as started on day one, if furnished holiday lets are no longer eligible for capital allowances, that's going to be a bit of a no-no, I would suggest, with HMRC. The other thing that furnished holiday lettings will cause issues with in the 24-25 returns is there's the anti-forestalling rule. But again, that shouldn't affect genuine transactions with third parties. But I just flag it again for completeness. High income child benefit charge. I've spoken about this quite a lot over the years. The spring budget 2024 increased the threshold to £60,000. It hadn't increased since it was introduced in 2013. So you've now got a scenario that high income child benefit applies where there's one taxpayer and a household claiming child benefit, which is adjusted net income between above £60,000, and then the child benefit is completely withdrawn once adjusted net income exceeds £80,000. Now, flag a couple of things here. The first is if you've got a client that was previously caught by high income child benefit charge and elected not to receive their child benefit, there is that opportunity to go back to that client and say, well, actually, you could go back, your earnings, the threshold's gone up, so your earnings are now no longer within the scope of the high income child benefit charge. You could go back to HMRC and ask for the child benefit claim to be reinstated. Now, it depends on whether or not sometimes people have not claimed it at all, and you can only backdate 3 months. But if you've claimed and elected not to receive child benefit, you've then got the option to reinstate that claim and have those payments brought back. So there's an opportunity to look at the change in threshold and whether or not child benefit could be claimed. On the other side, for those people who will still be caught, they might not necessarily have to complete a self-assessment return to pay the high income child benefit charge in future years, because the spring budget this year announced there's going to be a new digital service launching in summer 2025. We haven't got much details on this, so I'm just flagging this just as one to watch, but it may well be that if someone say they've started a new job that is brought them above the threshold, that they actually might want to pay the tax as they go, the high income child benefit charge as they go, to avoid any big tax bills coming through when they do their tax return in due course. And some other miscellaneous changes. In the TUSAR, we had HMRC expressing a desire to move to paperless letters. Now, HMRC will save £50 million in postage and print costs. Now, we are supportive of this because sometimes letters are going astray when HMRC send them, and it takes time, and there's a cost in that. And if it could go on something like the agent services account or be sent electronically, I think a lot of our members would find it very, very helpful, provided that the letter has the client reference in it. There's a suggestion that some of the non-statutory corporation tax letters could be removed altogether, possibly. But again, we've been in discussions with HMRC to say, well, we actually want to make sure that the anything that is sent to clients is anything that's sent to clients is beg your pardon, sorry, my dogs are just barking in the background. Lost my train of thought there. Corporation tax letter, anything that's sent to agents is on online portal, and there may be other ways to communicate non-statutory letters to clients. The last thing on there, it was announced a little bit ahead of the spring statement, was that income tax self-assessment reporting thresholds, that's changing to £3,000. And a lot of people, there was a bit of miscommunication online. People thought this was a change in the trading allowance to £3,000, which has been £1,000 for a number of years. That's not changing. It's just that the requirement to pay the tax via self-assessment is changing. There'll be another way to do that. We're still waiting on a little bit more of details. So, but it will mean that some taxpayers won't have to go through the process of completing a full-blown tax return. They might be able to do that through an online platform. And I think that was all I was going to cover. David, I don't know if we've had any questions while we've been going through all the different bits and pieces there.
Yeah, thanks very much, Chris. That's great, and we'll bring Justine back on here just now as well. Justine, I've actually the first question, I guess, is perhaps for you, which is around the mandating of payroll benefits, and while that's been delayed, I guess there's a question of, would you encourage employers to register for the payrolling benefits before it's mandatory? On a voluntary basis, and is that perhaps probably going to be driven more by your software provider, and whether they're able to deal with that? Just your thoughts on that, I guess.
Yeah, thanks, David. It's a good question, actually, because there are a lot of people who have already started payrolling benefits. The difficulty is that you can't payroll all benefits at the moment. Two very good examples are beneficial loans and living accommodation, because the legislation isn't written in such a way that it allows those things to be payrolled at the moment. So we're calling for those things to be sorted out before payrolling of benefits becomes mandatory. And in fact, just to sort of digress for a second, there is an expenses and benefits forum which is taking place. And because we know when it's going to be mandated now, that's been cranked up, and the policy forum is meeting once a month now until it comes in. So we have the window of opportunity as policy experts to place a lot of pressure on HMRC to make sure that everything, their systems, their legislation, their guidance and everything else is completely right and correct before it goes ahead. But yes, some people are already doing it. Let's say if you do private medical insurance or company cars or things like that, they can be payrolled at the moment, subject to your software allowing you to do that through your payroll system. And it's proving to be reasonably easy and straightforward for people to do that. And the only trouble is that obviously if you've still got to pay your class 1A national insurance, which you then have to do through the old sort of P11D system, whereas new payroll systems will be being designed so that when payrolling of benefits is mandatory, that all happens automatically. The class 1A gets paid, it's all sorted, and it'll just get done as it happens, which may end up being good for cash flow and things like that, because obviously class 1A national insurance is currently a lump sum that you pay in July, so as you don't get a penalty, you have to pay it before the 22nd of July. But it's capable of being done at the moment, but it just needs more software houses to develop software and more employers to get involved with it. If any employer wants to get involved with it up front, they can. It's not a problem.
Yep. That's great. Excellent. Thank you, Justine. Chris, just coming to you just in relation to the double cab pickup side of things. As you said, it's quite a change for certain industries and certain sectors and such like. And I guess, how do you see, or are you already seeing some changes where it's impacting clients' vehicle purchase arrangements or their habits? I guess what are you seeing around that?
I think it depends on the sector, David. So I think there'll be some clients in, say, the agriculture or fishing sectors who are actually buying those vehicles because they need them for their employment. And I think this is the way that this sort of blanket treating of all double cab pickups in the same maybe is a little bit unfair. But as I've come to realise in life, tax isn't always fair. And we just have to run with the rules that are and there. I mean, on the other side of things, there are maybe some people who have used double cab pickups as their main family vehicle because some of them you can actually do quite a lot with them. And I've never driven a double cab myself, but I know a lot of people. Sometimes there's maybe that street cred in certain parts of the country that having a double cab pickup is a cool thing to do. So, but even more so if you were able to get very, very low benefits in kind and the business was able to claim a high level of capital allowances. So I think it's still early days yet. I was aware that there were quite a lot of issues with finding commercial these double cab pickups where there was a rush to get them before the rules changed. Just in that as a sort of one-off flurry of activity in the market. But beyond that, it'll be interesting to see how it impacts on demand because I think there will be some people who have specifically bought a particular vehicle because it was classed as a commercial vehicle for tax purposes. Yep. And I'm sure that people will have sold them on those bases as well. It'll be a selling point of certain vehicles. So whether that reduces demand in the wider market out with the agriculture and fishing sectors, it'll be really interesting to see what happens there.
Yep, excellent.
I think, David, can I just come in as well?
Yeah, sure, of course.
I think that, you know, the sort of agricultural and fishing sectors might feel a little bit hard done by as well, especially the sort of farming community in particular, because you know they are very much needed, those vehicles. You know, if you need to get a dead cow out of a field, there isn't really a better thing to pull it out than a double cab pickup because it can stand the weight and not tip over or whatever. So you know, you don't always have access to a forklift truck or a digger or something. But in addition to the sort of the rules around sort of inheritance tax and farming families and things like that, I think they're feeling a bit hard done by at the moment with these extra double cab pickup regulations.
Yeah. Chris, Justine, thanks very much. We are unfortunately running out of time. So thanks once again for your insight and your knowledge. As we draw this webinar towards a close, it'd be great if you could just leave us a rating for today's webinar. There is going to be a quick poll just appearing on your screens or in the chat box, depending in which version it is that you're using. So if you could please just give us your feedback, that's very much appreciated. And please remember that you can keep up to date with all the latest tax and other professional news, including the latest information, guides and resources on the icas.com website. Chris mentioned a number of articles which are going to be going up there in the next week or so, which would be hopefully useful for you to access. And of course, you can access technical support if you have any questions on tax or any of the other areas through the ICAS Technical Help Desk, which is also available through icas.com. Just looking forward, we have a few events in the coming weeks which you might be interested in. As was already mentioned, on the 5th of June, Justine is going to be back as we delve into a sector special looking at the implications of making tax digital for the construction sector. And then on the 17th of June, you can join a panel of experts from Revenue Scotland who will be providing valuable insights into the key issues surrounding LBTT and helping you navigate those processes and get your support for clients who are buying, selling, leasing or investing in land and property in Scotland. And please don't forget that if you're in practice, that on the 11th of June in Glasgow, we are hosting our annual practice conference where we're able to explore with you how you can thrive in 2025 through a focus on our 3 themes of people, process and technology. And during this full day in-person event, you'll be able to hear from an exciting lineup of speakers as we lead you through the sessions and workshops that will allow you to focus on the direction of your firm with lots of practical takeaways and ways to build value in your firm. And I'm pleased to announce that just yesterday we have had confirmation that HMRC and their lead on Making Tax Digital will be in attendance at the conference. So if you do have any thoughts or queries on Making Tax Digital, pop along to our conference, sign up now, and you'll be able to raise them directly with HMRC. And on the 18th of June, you can also join us in Edinburgh for an exploration of Scotland's fiscal future as we look at the evolving economic landscape, Scotland's tax system, and its financial stability. So links to sign up to all those ICAS events are available in the events section of icas.com. It only leaves me to thank you, the audience, for joining us on the webinar today. I do hope that it has been helpful to you, and thank you for joining us. And until the next time, goodbye.